We're wrapping up the key themes for 2022 and those that we see on the horizon for 2023. I'm Michael Smith, and welcome to the Lowdown. Hey everybody, welcome in. Joining me today is Chris Roberts. Chris, welcome back. And you know what? I couldn't think of a better person to be here to talk about what's happened this year. And of course, what do we see on the horizon for 2023? Definitely not going to be a shortage of topics. I think many things to discuss. But let's kind of get through 2022. Probably the biggest, I think, theme and the biggest change we've seen is kind of the role of the Fed. And as far as the biggest topic and what everybody's talking about is inflation. But what are some of the other things that maybe people probably didn't pick up on? I think we did a pretty good job of picking up on this year and kind of getting us into next year.
Well, that's exactly right, Mike. You know, we had a lot of big things in the headlines just last week with inflation, the Fed. It's the, rinse and repeat every single month. Markets all gravitate around what the Fed says and what CPI does. But I think there were a lot of embedded themes throughout the year that I think really set the stage for next year that, like you said, we hit on this year, but I think we're taking time today to record this episode, this year-end wrap-up, Christmas episode, if you will, to kind of talk about some of those more granular themes or things that weren't on the surface, right? So something that I've said on the show a lot this year is this sort of pattern of a return to normalcy. I know that kind of raises an eyebrow, but when I look at the last couple of years, right, and what the government and the Fed did during COVID is they created that kind of some respects an asset bubble, right? They created a rising tide lifts all boats situation where I could take this pen, throw it at a dartboard, and that stock would probably go up coming out of April or May of 2020. That is certainly not the case this year. It's certainly not what we've seen in 2022. So I think that COVID era ZIRP policy created an asset bubble, plain and simple, both in stocks and bonds, and NFTs, crypto, everything in between, you name it, right? And so that really lends way to a big kind of theme that was present prior to COVID, 2015 to 2019, which was the MMT theme. You and I talked about it extensively. And in fact, Mike, you were one of the first people that I met that knew what it was, so to speak. And you and I had a lot of great conversations in 2018, 2019 about that when we didn't have as awesome of a studio built up and things like that. But, I think that MMT is largely dead, right? Ultimately, what we found out this year is that inflation still truly is a monetary phenomenon. You print money, inflation happens, but it also is how much we expand the money supply and how rapidly. Think back to the episode a few months ago, we brought up that money supply chart that a few of our listeners are like, gosh, what does that say? All it says is basically the velocity at which you print money is a primary determiner of how much inflation you have and how quickly, right? We shot the money supply up, and then sure enough, 6 to 8 months later, inflation shot right back up. Well, guess what's happened over the last few months? It shot right back down. So that could lend way to some precipitous drops in inflation in 2023. But then we've also seen other things with higher rates, right? Higher rates means we don't have as high of a need for speculative investments, right? We talked a lot about the TANA trade, the last couple of years. That there is no alternative to stocks, right? We were finding new ways to generate portfolio income while keeping portfolios diversified, but ultimately you couldn't do that with fixed income. Well, now you can. You can find reasonable yields in the fixed income space because prices have come down so much, and yield and bottom line Fed funds rate yields have come up so quickly. So I think that it creates an environment where it makes sense to own bonds. But then back to my broader theme of normalcy is that fundamentals matter again, right? We're seeing analyst after analyst comment on their balance sheet doesn't look good versus this company in the same sector. That wasn't happening during the COVID boom and the COVID era, market boom and what have you. It was, again, throw the dart at the dartboard. Well, now it matters, is X company better than Y company in a sector? And I think you've got a thought on that. So
well, I was going to say, let's, because I think that's a very important point. I mean, for one, if you use ZIRP, which, by the way, acronyms, in case you don't know what that is, zero interest rate policy, which we've been there for, over a decade. And let's think about it. Investors, you talk about throwing a dart, hitting a stock. Investors have felt pretty good in the last decade or so. Why? Because they could pick anything. They feel like they're geniuses. They feel like they're big hedge fund managers. But in reality, the Fed has been right behind them. The Fed's been the big push. I think what you're highlighting is you have to return to doing the homework. So back to fundamentals, meaning you've got to take the time to dig in and really see what you're buying and make sure it's accurate, make sure it's a good value. Where before you really it didn't matter, right? You had this big wave of money, talking about MMTs or interest rate policy. you had a lot of money kind of pushing everything. But the Fed, and I think the biggest change going into this next 10 years plus, the Fed is not going to be at your back the way it's been. And that goes for real estate. That goes for just about any asset. And I think it's very important as an investor, you need to understand how that works. And quite frankly, you haven't seen that in so many years. People forgot what that's like. But I think the biggest part there, return to fundamentals. You need to take the time. You're going to have to do more homework to invest in this landscape going forward.
If you're going to buy individual stocks in this environment, that's what you have to do, right? It can't just be based solely on, oh, well, Tesla's a great example. We were talking about it before the show, right? People that know me personally know I think maybe a potentially overvalued company.
Just a little.
Just a little bit. It's come down a little bit, but we're talking about a company that makes 4 cars with a larger market cap than Ford. It's like that's the kind of stuff that I'm talking about, where it's like the balance sheet, the income statement doesn't line up with the valuation.
But people buy Tesla
stock
because of Elon, right?
They
buy
it for the sentiment, right?
Yes,
that goes back to stocks are sentiment based. It's now not just sentiment based. It's I think we're coming back to fundamentals here, and I think that's a good thing. I mean, I've said it throughout the year. I think that ultimately is a positive development for markets rather than negative, right? Because it makes it easier to some degree to evaluate markets and the underpinnings, right? Or which sectors, regions, and industries you want to be invested in if you want to keep a ETF-based, broadly diversified approach, which I know we still, advocate for here at Avidian. So, and you highlighted the role of the Fed, and that's 100% correct. The Fed, since the great financial crisis, it's been the Fed put, right? It's been the when in trouble.
Greenspan put to Bernanke put to
they
now.
They will save us, right? Well, that is not the case anymore. They've shifted their narrative to being solely focused on growth. Now that we've got high inflation, now that they maybe made some poor choices during COVID, now it's how do we grapple between controlling inflation and promoting growth? And you really can't do both at the same time.
Yeah.
So you've got a much more active
You got to push on one harder and let the other come around about. And that kind of gets me into the inflation. That's been the big topic. I mean, there's nobody listening that probably has not felt the effects. I mean, if you've gone out to eat anywhere, it has gotten to be ridiculous in some areas more than others. But, commodities kind of return to normalcy. For one, let's talk about pre-pandemic. I don't think we're going to get to inflation rates pre-pandemic. So for many people keep talking about that. I know the Fed says 2% is our target, but let's be realistic. I doubt they're going to get close to that target,
and
right?
We'll talk about some of the driving factors behind that, because this will be, a longer episode, but we'll definitely chat about it. We've got the 3 Ds, so to speak, as kind of a preview.
Well, those are going to be big time, but huge. But, so I think inflation is kind of a fading. I think if we saw from the last CPI report, it came in better than expected. It kind of seems like it's plateauing, right? And I think it's going to take a little while for it to be driven down. I think the Fed, one thing they're doing different is the Fed seems pretty committed to getting that under check. And I think what they've laid out, and I think they've done a pretty decent job, is kind of where now the future increases of rates. Remember, it was 75, it was a little uncertain. Now they say, hey, we're going to raise 50 and maybe another 25, but they're still going to raise rates. I think the terminal rate will probably get at 5.5 is kind of the target I'm hearing, right?
And that target's shifting. That was one of the big takeaways from last week is that, hey, we've shifted where most investors and institutions expected rates to roll over in 2020, second half of 2023. The Fed is projecting something different, but markets are still pricing in, that rollover in 2023. That goes more into the idea of, a recession, the intensity of a recession in 2023. And that kind of brings us back to, our next topic, which was, answering the question that's on everybody's mind is a recession coming? And I think my answer to that would be, in some respects, we're already there.
Yes.
And that's the thing. We had the GDP numbers, and a lot of that's now since been supported by, a strong dollar and good, good exports versus imports and what have you. But I think it's been kind of clear all along as we've gone throughout the year that a recession may have been somewhat of the goal the entire time of the Fed. And that's not saying, okay, the Fed wants to see the economy go into contraction. But I keep a rubber band on my desk, Mike. And when clients call and they ask me about markets, think about what we did during COVID. I wish I had my rubber band right now.
I don't know. You might hit yourself.
I might smack myself, right? But, what we did at the end of COVID and during COVID is we injected the economy full of jet fuel. Then everybody was able to spend again when the vaccines rolled out, cases subsided. It was really after Omicron there and what have you. And then start of 21 and throughout 2021, we pulled that rubber band really, really tight upward, right? And that is the demand up string. And people had money to spend. They had built up savings throughout COVID and what have you. Well, what happens when you pull a rubber band? The harder you pull it, the harder it snaps back, right? And so I think that we're ultimately getting into that snapback phase, right? Where everybody's being squeezed, right? It's like your personal pocketbook's being squeezed. Margins at the company, at the corporate level are being squeezed. Savings rates are declining. All these different things, they're all, preliminary indicators of a recession or that it's coming very, very soon. So then the question I oftentimes get asked, of course, is, has the market bottomed? Has it priced in the recession? And I say, I actually said this recently. I said, if you'd asked me that question back in October, I may have said yes. But I think that after the run up that we saw since that October low, both in stocks and bonds, I think bonds are in a better shape, but especially in equity markets, with that big run up that happened, and then Powell said, "Hey, I've still got work to do."
Yeah.
Markets are getting in front of themselves. So
market got a little excited, too excited, too quick.
A lot of commentary last week was Powell basically saying, "Pump your brakes.
Yeah, hey, hold on.
We don't want a 1980 situation where we pivot too early or something like that." But I think this really kind of lends us into a chart that we've highlighted in meetings throughout the second half of the year. We'll flash the chart now. It's probably going to look a little bit small.
It is.
On the YouTube screen, so maybe throw into full screen, so to speak. But basically, this is just an example of 6 recessions. We've got it here in front of us. And one of the big takeaways here is that, markets bottom before the economy does, right?
That's about a 6 to 9 month lag.
Exactly. And so, right now, we haven't seen all the shoes drop, right? Mm-hmm. And I think the big one that we'll talk about here is, the earnings side, right?
Correct.
Earnings still look really pretty good for 2023. And so we anticipate that somewhere in that first quarter when Q4 releases are coming out, they're laying the stage for 2023. Well, you see a lot of revisions lower. That'll make stocks look far less attractive than they do now from a valuation perspective. Again, back to normalcy. And so I think we could see another leg down in equity markets in the first 3 to 4 months of next year.
Yeah. So that was what was going to be important. And there's a lot of things you're bringing up there, but good stuff. First of all, you're absolutely right. I believe we're in a recession, and we've seen the markets correct. And as you see in all these 6 recessions here, the blue line basically being the S&P, you see the markets correct before the earnings, which now that's kind of the next story, and unemployment, right? So that's kind of where the laggard part, and that's typically when they call, by the time the unemployment rate's high, that's when the NBER is basically calling the recession. Well, it's too late to do anything. I think as far as equities, we've probably seen 80% of the move done. If you take out 2000 and 2008, basically the tech wreck and the housing bubble, we're probably about what a normal recessionary type market correction should be, right? Yeah. But if you add those back in, we're probably maybe 20% to the downside. So unless something major happens, I think we're probably mostly through. I think the next big step, and I think one you'll probably agree, is that we need to get a retest of those October lows. If we can make a higher high on the market, that's going to give me a lot more confidence that, maybe we've seen the bottoms in and it's behind us.
Well,
so
and to the point about, where does the Fed come in? And I said, it could, this is, I saw a phrase over the weekend when I was doing some of my weekend reading, and it's like, the difference between this recession and past recessions is that in some respects, this one's engineered. Right.
Yes,
so these 6 charts that we showed may not play out in the same timeline. I still think it will occur that way, but I think that's really where the soft landing is coming in. This whole talk
and
about
that's what they're trying to navigate.
Is basically, can we create a very shallow recession? Can we create one that doesn't feel as, because again, we get flashbacks to the great financial crisis, and there's not that kind of a credit crisis brewing or anything like that, but a shallow recession where we can reset and let that rubber band snap back. I mean, look, we already saw it last week. November retail sales down 0.6% in a seasonally strong period. That's that rubber band snapping back. That's people saying, I don't have the money to go out and shop for Black Friday. You looked at,
because Black Friday turned into Black Monday, Tuesday, Wednesday.
Yeah, the companies got wise. They were like, people aren't going out to do this anymore, especially after COVID. So, but, I think December's numbers will be very telling with regards to sales. This is the most seasonally strong period. Families coming in town to go out to eat.
Well, then how much does credit increase on top of that, right?
Exactly. And I don't have the number in front of me, but the household usage of credit has exploded over the last 6 months. And not only that, but the cost of the credit's gone up too. So you're getting squeezed by both ends. And that's a negative shock right there. But, again, it's, we'll see how long the Fed lets it run out, but they know that the best way to get inflation under control. At least not the best way. I mean,
so they got to get us through a recession.
Yeah, they've got to get us through a recession. Hopefully that's shallow. And I think they can still pull that off.
I mean, Chris, I think probably, let's go back to September. Had you told me, hey, do you think the Fed could navigate a soft landing? I would have probably disagreed. I thought maybe they probably couldn't. I think they're doing a good point right now, is at least setting the expectations. And if you keep in mind, they don't necessarily want the stock market to go higher, but they don't want to crash it here. Okay. If anything, they want to kind of make it smooth. And I think they've done a pretty good job of laying out, the path of where they're heading. And remember, markets hate uncertainty. So if the Fed comes in and, has another, if Jerome Powell puts his foot in his mouth again, then that could be very damaging to the markets. He's trying not to do that. I think for the most part, we've probably seen the Fed's done for this year, right? I mean, we've got past that meeting. So now it's going to be going into next year and I think seeing what did the final retail sales, what is the state of the consumer going into 2023, and then now dealing with the recession, and ultimately the next two things which we had on that chart is now dealing with bad earnings, right? And then, of course, how far does unemployment get before the Fed says, okay, you know what, enough. I got to focus on the other side of my dual mandate, which is employment. Well, I think they let that go further than most people think.
Yeah. And I agreed, Mike. I 100% agree with your points there. And, I think that, the timing is going to be key, for the Fed more than anything here. Like you said, I mean, it's, the Fed's always been in a rock and a hard place. And I think that I don't think they're going to hit their unemployment targets per se. Unemployment on the upside as a sign to pivot very easily. There's a lot of structural labor, inflation or strength to the labor market, which we'll get into here in just a minute. But, I think they can't lose sight of how the everyday American is feeling too, and then the other side of that too is, I've said it time and time again every time you've had me on the show, where they're focusing on backward-looking data to make forward-looking decisions. What you and I have talked a lot about with respects to credit, household savings, and things like that, those are forward-looking data, economic indicators. And the Fed knows better than to get too locked into those, because that's how you make a mistake. That's how you potentially, pivot too early, like we saw in the 80s or something like that. So, these are all things that they have to grapple with. That's why they're, necessarily the ones in charge. We might have our own opinions about how they should and shouldn't be doing things, but we're going to squeeze the lemons to make lemonade with wherever the Fed lemonade tree or lemon tree comes from. That was a weird statement, but it was still they planted the lemon tree, and we're going to squeeze those lemons regardless. So,
well, in respect to 2023, that's, I think, again, the recession. It's here. Now dealing with those last two that we talked about, earnings and basically unemployment. Well, let's kind of pivot a little bit. Let's talk about as an investor, right? Yeah. I mean, you're listening. What should either your team, yourself, what should people be doing? And I think you and I talked a little bit off air, but let's kind of bring that into the conversation on the planning side.
Well, yeah, and Will, I think you had hit on what we haven't hit on yet, so to speak, okay. And let's kind of touch on it from a market's perspective. Is we want to bring up fixed income. Yes. We've been talking a lot about potentially rotating back to fixed income. We've talked individually with all of our clients about that. Whereas yield replacement's been on
we're doing that
and now we're doing some rotation back. And so we'll flash a chart up here, but basically it's two charts side by side. We won't keep them up too long, but basically what it says is that when the yield or current yield rises so precipitously on the overlaying aggregate bond index, forward-looking returns for bonds go up dramatically. That's to be expected, right? Because bonds reprice when yields go up so quickly. So I think that from a forward-looking return perspective, I think that fixed income is a lot more attractive. Remember, bonds are much more mathematically priced than stocks too. Stocks are sentiment-based oftentimes. Bonds are, there's basically just math. That's
like we say, it's an equation.
Yeah, it's an equation. Stocks, there are plenty of equations, discount cash flows, CAPM, all that fun stuff. But really, when it comes to fixed income, it's all math-based, right? It's all a function of that bond sensitivity to interest rates and what have you. So as the Fed continues to downshift, going into next year and going into smaller hikes, you probably get some pretty good bullish momentum behind fixed income, not only to still pick up some really good yield in the first half of the year, but then also greater potential for capital gains as well as they do downshift.
Well, keep in mind, yields above inflation, and that's the thing for fixed income. When's the last time we've seen good, attractive yields above inflation? We haven't for a long period of time. And I think what we're saying is we get to the end of this Fed run, right? Basically kind of easing, kind of tightening. Then I think what we start to see is some pretty attractive long-term, yields above inflation, which we haven't seen in forever.
Well, and then let's just, speaking of inflation, in returns, let's throw up a few more charts here. So we've got a good one that we've kind of had in our own little internal slide deck for a few months now, but it's basically, what do returns look like after peak inflation, right? We've got the period highlighted on the grid there, but ultimately, typically returns are quite positive, after we've hit peak inflation, right? So that happened in June of this year when we had 9.1% on the CPI. So, we could very well see a good rally. We're still going to see some volatility still in the first quarter. But, ultimately, again, markets are usually pretty positive 12 months after. So let's see what happens. Let's come June 2023, does the trend stay consistent here for stocks and stocks and bonds, coming after peak inflation? You have a double-sided argument there. But then also, just generally speaking, the S&P 500, after falling 25%, you give yourself 24 months on average, we're probably going to recoup most of those losses, if not all of them.
So staying the course is important.
And staying the course is very, very important. We've talked a lot about that. It's going to be very difficult to time everything over the next few months. You've seen how much the goalposts have moved this year and how rapidly. I mean, a couple weeks, even before last week, we had the big rise where we had the big, 1,000-point day. I mean, the CPI day was crazy. The intraday volatility, it kind of goes back to the,
you saw the VIX index.
We had the Dow popped like 1,000 points and then finished up 100, on CPI day. That just kind of shows you how quickly things are moving. And it's better to, like you said, in planning wise, stick to your planning driven risk allocation. You've stress tested that risk allocation. And stay invested. And it's impossible to time it. You can make movements within periods, right? Saying, I think healthcare looks pretty good for the next 4 to 6 months. We'll go there.
Yeah.
But going cash in, cash out, cash in, cash out, I think you're going to end up on the back. You're going to end up at the back foot after 24 months.
Absolutely. Play the rolling volatility. You mentioned volatility. We've been so much, I think, just really conditioned over the last decade plus that volatility is a foe, right? Yeah. We've learned to become scared of it. We've learned that the Fed would step in and help reduce that. Well, they're not going to. And I would look at it as think of it from this point. Get the financial plan to really dictate what type of risk you should be taking. But from that standpoint, start embracing volatility a little bit more. One, I think it's going to be a lot more frequent. We're going to see more volatility. I think recessions and recoveries are going to be more frequent in the next decade. And I think, quite frankly, just embrace that volatility and have a part of your portfolio, or at least some structure in your portfolio where you're taking advantage of that. And I think that's what we're talking about. Not selling and going to cash and trying to get back in, but roll into different thematic opportunities within the markets.
And there are individuals out there that'll do that, that'll raise cash, deploy cash. But they're some of the most successful hedge funds in the world, and that's why you want to have alternative investments in your portfolio, because a hedge fund exposure is an alternative investment.
And you're not going to replicate that on your own.
No, and that's 100% correct. Well, and in thinking about, just kind of wrapping up 2022, we've already kind of gotten a little bit into our outlook for 2023. I think we've pretty much, beat that horse, so to speak. But, just a couple more statistics for everybody, throw up this side-by-side chart. 2022, like we've talked about, that's the most jarring thing. The worst start for bonds ever. By a very wide.
You look at that
margin.
chart. Do you see even a close second on that chart? This is the worst year by far.
Yeah, we're referencing to the 80s when it was the last time we tightened monetary policy so tightly, so quickly in this country. But again, we were coming off of all-time high valuations for fixed income. The shoe dropped, I'm not going to say the bubble pop per se, but it was just 40 years of declining interest rates. And now we're finally getting into a sustained period where they're going up longer than a couple of months, like we saw in 2018. And in fact, 2018's on this grid. It's toward the bottom there. But look at the next 12-month returns in 2018 for bonds, 10.3%.
Yes.
So you can see just with a 1.6% drop in the first 9 months of the year, the next 12 months, 10.3. There you go.
On a safe asset, by the way.
That's that asymmetric return argument I'm talking about in fixed income. And then for stocks, we have that chart too. That's a little bit more mixed, but it's the fourth worst start. More times than not, we'll see positive performance after those first 9 months.
Chris, some people are saying this is the worst year in terms of portfolio returns, impacting more
60,
people.
40 or something.
And think about a lot of the boomers; they're at the end of retirement, first couple of years in or about to. So this really hit people at a very difficult time.
Yeah, definitely. And you'll notice the next one that's on the list there for stocks is 01. And we talked a lot about how asset prices were inflated, but not to the extent that I think we saw in 2001. I think that was a revolutionary bubble, right? That was the .com boom and bust.
That was
period,
one big sector.
If you put netcom after your name, it's like putting crypto in your name. So I actually likened it a little bit to kind of like crypto, but that market got nowhere near as large.
It's the crypto
as, let's say,
of the time then.
Yeah, but luckily, in some respects, I know this is going to sound strange, but in some respects, there has been that trend has been clamped a lot sooner than what we saw in the dot-com bubble. And crypto is now facing some serious headwinds, for good reason.
Yeah.
Whereas the dot-com bubble was allowed to flourish a little bit
longer. Yes, I agree.
Exactly. So Mike, let's kind of get into the final third of the show here, I think too, and that would be, what are the key themes for 2023 and beyond? And it's not just what's going to happen in the next 3, 6, 9, 12 months.
Well, we call them the 3Ds, but I'm going to let you set those up.
Yeah, so we got 3 things: demographics, deglobalization, and decarbonization. Now, a lot of those are socioeconomic things, right? There are both a political aspect and an economic aspect.
Sure.
We're going to focus on the economic aspect. I know a lot of people have a lot of opinions on the political aspect on a lot of these things. We are just reading the tea leaves as they're presented to us and the economic effects of
There's a lot of upsetting things coming politically, so just be aware.
So the first one is demographics, and we'll throw up this side-by-side chart. But the big thing here, as you see in bold, is fewer workers means the economy cannot produce as much without generating inflation, right? We have a very low birth rate in the developed world, also in China, to the point where it's going to likely become contractionary without some big catalyst for people to start having more kids. But then also COVID, it accelerated this trend with people aren't having kids after COVID as much. Mm-hmm. Maybe that's because of the inflation or what have you. People are just scared for the future. Accelerated retirements was also a big thing in COVID as well. So there's just fewer available workers, and for that matter, skilled workers that need to be, we don't have the right butts in the right seats either. No. And so there's a lot of dislocation that gives workers who are well trained a lot of bargaining power when they go to negotiate a new salary every year. But then also it just brings the labor force participation rate down, right? We have fewer workers available. And so that creates not cyclical inflation, but sticky inflation, right? Where, we can have, where that whole 2% target thing may not be a reality anymore. And we come back to planning there, and we'll continue to do this. That's why we've always run our plans with 4% inflation. We've raised a lot of eyebrows doing that. And if you have a 40-year time horizon in your plan, you'll say, gosh, my $100,000 in living expenses went to $400,000, by the end of my life.
It's kind of hard for people to figure that out.
Yeah. Well, it's just 4% compounding every year, but that's why we do that, right? We want to stress test the plan. So to speak, especially also for years like we've experienced in 2022.
Well, Chris, on that, we've gotten a question literally for the last 15 years of plans. People ask, 4%, doesn't that seem too high, as you mentioned? Now, for the first time, people are asking, is it high enough? And the answer is yes, keep it at 4%. That's why we did it prior to. We're going to smooth that out over time.
Exactly. And if we feel a need to change that, we'll talk about it on the show.
You won't like it if we do. The plan does not look good. Add one more percentage on inflation, it really alters the plan.
Yeah, exactly. And so, in moving to the next theme, this is really more so about deglobalization, right? We've seen it over the last 5 years. It accelerated during COVID because of what happened with supply chains during COVID. That was a pitfall of globalization. We could not get goods from point A to point B across the Pacific and Atlantic Ocean like we could prior to COVID. And so that really accelerated the reshoring. It accelerated the nearshoring, right? Or bringing jobs back in within borders, or from the United States case, building Ford trucks in Mexico, trade partners, whatever that might be, exactly. And that ultimately is a very, very expensive process. It's not so much, I'm not pro or anti-globalization, but the tea leaves say countries are pushing for deglobalization. So the cost of doing that is very high. And that's why we've got this little slide with, let's say, 6 bullets on it. It really goes back to, it takes time to do this. That isn't to say that it couldn't produce good results in the long run, but we're talking about a 10-year transition to get more production and whatnot inshores or nearshored. Let's say, let's just focus on the United States. You can't do that overnight.
No, that's going to take me a decade, if not longer.
Yeah, definitely. And then of course, I like to kind of highlight the second to last one here, really both, is more barriers for technology and knowledge transfer, right? And that's the big thing, that the indirect effects of globalization, which are really, you can get the best possible theories and ideas and engineering techniques possible across the globe. And now there's more competition on that front, where, think about semiconductors, the CHIPS Act and all that. That's protectionist of where the United States has a lot of innovation, right? We produce a lot of these chips in China, but we own the IP and all that stuff. And now we're trying to protect that IP, so to speak. Well, if Intel's going to build that new plant out in Arizona or wherever it might be, and what have you, that's very, very expensive. And those workers cost a whole lot more here. Eventually, it could shake out. It could create a better competitive landscape. Who knows? But the bottom line is that in the mid to long term, let's say over the next 10 years, that could create some sticky inflation.
Yeah.
And then the third theme that we've talked a lot about, and again, this is one that can ruffle some political feathers, but at the same time, it's important that we talk about it, because if we're not facing reality, then you're not making good choices. And so decarbonization, that's been the push, so to speak. And it was, and during COVID, it wasn't necessarily accelerated as much as it seemed more realistic, because people weren't consuming as many fossil fuels. Airplanes weren't in the air and what have you. So
we had negative oil prices. Everyone was scratching their heads. Some of the smartest people in the room were like scratching their heads. How did that even happen?
Right, exactly. Right? And that was a shock, if you will.
Oh, absolutely.
It was a market inefficiency.
And nobody wanted to touch the oil sector, the energy sector. You couldn't even bring it up. Private equity, VC, nobody could even raise money. It was just the redheaded stepchild no one wanted to talk to.
Yeah.
And now
there's an opportunity for oil and gas in the long run here, over the next 10 years. But in thinking about decarbonization, what's creating this? Well, it's that political push, whether we like it or not. It's that political push. And so I like this kind of side by side. We'll throw up on the screen here. And this is another one of those charts that's a little bit involved, so we'll leave it up for a second. But basically, the one on the left shows you how much demand for these rare earth metals to get the batteries and all that stuff, the solar panels, is going to grow by 2040, which is effectively doubling or more for some of those. But then also the most important thing is, who are the biggest producers of those metals? We can't get them in Colorado. We can't get them out in the Rockies. This is China.
It is one of the scariest things. I read a book by Marin Katusa that goes into detail about this. But literally for the United States, even if today, let's just say we moved through politically and we said, let's go ahead and start putting the CapEx spending towards mining some of these, we're still a decade behind. And yet we're making a big push to go to electrification. And you see from that chart of all the different materials we have, where they're located, you talk about, I think one of the biggest outliers we'll see over the next decade is geopolitical tension from this.
From China, exactly. They hold really the cards when it comes to decarbonization. And ironically enough, they're one of the nations that's basically most vehemently against decarbonization.
It's actually one of the things that scare me the absolute most going into the next decade.
Absolutely. And then ultimately what it creates is sticky inflation, because that not only we have rapidly rising demand for these rare earth metals and they're expensive, but then also China holds a lot of the bargaining power on this front. They can say, hey, you want to decarbonize? Great. Well, you got to buy those metals from us, and we hold all the supply. So that, and I think this lends way to a larger piece there about, a lot of people have said, well, is what's going on in the Ukraine going to be what happens in Taiwan, for example? I don't see a lot of similarities here, if I'm honest, because of the power that China holds on the future world economic stage versus Russia. One is declining in a fossil fuel-based economy, and one is accelerating, becoming a consumerist economy for one, but then also is the world producer of these metals. That isn't to say that there are not investment opportunities or good prospects for the United States. You said it was scary, but ultimately, how we're going to use those metals as efficiently as possible, that brain trust is still here.
Oh, scary is one thing, but yes, as an opportunity, absolutely.
And the people who want to study how to
Yes.
better use these materials come here to the United States. And so that reinforces, we talked a little bit about the dollar, right beforehand too.
Well, dollars is kind of the governor, right? The world's, addiction to dollars. It's the one thing we've weaponized that really puts everyone in check.
That and IP.
How long does that play out? I think it's got some merit for quite some time.
I think it does. And that's because a lot of the IP's here, and no one wants to, no one wants to generate that new IP in China only for it to have be seized by the state either. I mean, we can be honest about that. That's a huge another piece of tension.
And they're not going to reverse that. People simply do not trust the Chinese. And look, the one thing, when someone breaks your trust, that's the hardest thing to gain back.
Well, the Chinese government.
And and the Chinese government, we're decades from that happening, right?
And so, just bringing this back to oil and gas, I said at the start of this little mini segment here, there's an opportunity emerging in oil and gas, and it's solely because the technology's not caught up yet. There's still a high demand for fossil fuels, and yet we'll throw the chart up. This is where you said there's no capex in the space. There hasn't been capex in the space since the 2020 crash. Is that because oil companies and producers and nations are scared? No, I think what they're seeing is that if we invest in this now, it's kind of a sunken cost, because eventually, different energy sources will catch up. And so in the interim here, they're going to have high prices because there's ongoing demand without a lot of capex to increase capacity, and these oil companies could very well reap a lot of profits. Now, what they do with those profits will be very key. We've talked a lot about how they can kind of become cash cows, kind of like the tobacco industry did in the 1990s, facing some other kind of political pressures, but then also they can use those profits to become leaders in the renewable energy space, which is precisely what companies like Shell.
Well, back to an earlier theme, you mentioned the fundamentals look very attractive. The debt coverage ratios on some of these energy companies are some of the best they've been. The yields in some of these are very attractive in some space. So, I think you're right, and I think this is one that tends to be able to play out for a while. Even if today, like I said, if all systems were go on capex spending and everyone decided to go do that, I still think it takes a while for that to play out. So I think longer term theme, that's going to be a great place to be.
Well, that's why we've talked about things like MLPs this year and things like that, where they've kind of been you said redheaded stepchild. That's similar there in portfolios for a long time, but now, it could become a good cash cow.
Agreed.
For folks. And so, Mike, as we kind of wrap up to today's episode and really the final episode of 2022, I can't believe the year's over already.
It's been a blink.
Yeah, it has been. And so let's just kind of, wrap it up. The investment implications of what we've talked about today is, ultimately central banks, they face a trade-off between growth and combating inflation. Mm-hmm. That'll make it so the Fed's job's a lot harder than it has been the last 10 years, and we shouldn't rely on the Fed to be the sole determiner of where markets go.
So do your homework.
Fundamentals, right? The Fed put, so to speak, is deeper out of the money, meaning when they step in to fix things, it will not happen as rapidly.
Exactly.
We won't see them catch the
they're not going to be as embracing.
Whatever. Yeah, exactly. They're going to be a lot more observant. They're going to sit back and they're going to stick to their guns, so to speak. We talked about the death of modern monetary theory. I think that's ultimately
it's on the shelf for now.
Yeah, it's on the shelf for now. Who knows what will happen,
And thankfully, it was looking very scary. I mean, that's truly printing money. And let me tell you, I was not excited about the prospects of that. I mean, that's a very scary, uncharted territory. Hopefully, we can avoid that for some degree.
Well, and that's the thing is, I remember sitting in the old studio and talking about MVT with you back in 2019, 2020, when we were the bare bones staff during COVID. We both were like, this is the reality right now. We don't like the reality.
Well, you don't like the reality, and you do not want to watch the sausage being made with that.
Yeah. Wow. Scary stuff. But, and then we talked a lot, not as much, but, there is going to be ongoing financial instability, especially as it relates to debt burdens. A lot of debt was generated during COVID, and that's part of the reason why the Fed can't step in like they normally would, is because we spent trillions of dollars as a country, and the world economies spent trillions of dollars. So did all that on debt. You can't necessarily be as cooperative or as supportive as you have been after doing so. And then, of course, fixed income. Yeah, we've got definitely higher yields, probably higher yields for longer. Equities, probably diminishing tailwinds for that. Throw the dart at the board, growth tailwinds where you can go buy, ARK and stuff like that and be like, all right.
The days of set and forget it, I would caution against that mindset going forward.
Yeah, and there's still, like I said, there's still very much so an argument for having, a core portfolio of diversified stocks and bonds and alternatives and what have you. But it can't just be buy the S&P 500 index and never think about it again.
Exactly.
You need to rebalance. You need to navigate how you're allocated, long and short term to global stocks, domestic stocks. And
diversified amongst different investment themes.
Yeah, exactly. Especially with stocks and bonds moving together more and more. We didn't really have a chance to touch on it today, but alternatives are increasingly important, both the liquid type and the illiquid type. And then, that kind of brings us into our final point, which is there are great tailwinds for active management here. And I think that, there's a good way to do that, right? Stick into that planning driven investment allocation or that risk allocation driven by, like at least what we do here with our capital markets process or capital markets assumptions process. We use that data to rebalance portfolios and what have you. And then, we use intermittent data to make those as actively managed portfolio decisions. But I think that's really the best blend you can find, right?
Agreed.
Active management's going to be important, not so much to the point where you're constantly gyrating in and out of markets, but
rethinking your bonds.
Yeah, rethinking your bonds and things like that. And
then making the place for alts. And like you said, there's different stages. There's some for non-accredited. So, there's definitely some rules around that. So you want to make sure those rules. There's some for accredited, and then there's some for what's called qualified purchaser. And then also looking at the different liquidity provisions on those. But the alts market is one that's really growing, and I think here at Avidian we're actually got a lot of different ones we filter out, so we're really able to help just any type of client place alternatives in their portfolio?
Well, when I was thinking about it, what's a great analogy for this? And so I'm going to have my in-laws to be and my sister-in-law to be and what have you all at my house on Christmas Eve night, my family.
I know what to get you now for Christmas. Then.
Yeah. I have my little townhouse, and we're going to have
some alcohol.
Yeah. Well, yeah, maybe. And so we've got 10 or 11 people going to be in my townhouse, and I'm going to make 3 pounds of red beans and rice. And that's one of my favorite things. Maybe we've got a Cajun family recipe going back over 100 years, whatever it might be. And so when I think about it, I think about my red beans and rice like I do portfolios, right? I could very easily throw some beans in there, throw some chicken broth in there, boil it over, let it sit there on the stove, and not think about it for the whole day, and then everybody will come over, eat it, probably be all right. But you know what I'm going to do throughout the day? I'm going to go in there and add a little paprika. Yes. I'm going to add some celery salt. I'm going to add some Tony Chachere's. I'm going to add all these little things throughout the day to generate the best product possible, the best food possible on Christmas Eve, right? That's what we can do with portfolios. That's what people need to be doing with portfolios is, oh, that's too salty. Let me add, some neutralizer. Let me add this, that, or the other.
Constantly monitoring and checking. It's a great analogy.
But it doesn't mean that I'm going to go in there and throw it all in the trash and say, it just doesn't taste right. I'm going to change it. It kind of goes back to just making little modifications along the way, not setting it and forgetting it, but then also not throwing the pan down the drain.
Well, I think that's a good end there, Chris. But if somebody wants to get your recipe, I guess they can email you.
Email me, call me, send up a smoke signal, or stop by. No.
I think you might get some traction on that.
You never know.
Well, look, Chris, we've had a lot to go through this year. I think we've gotten through it. We've navigated well. A lot more coming up. I think we've done a pretty good job of just telling everyone how we're going to prepare you, and if also at the same time how to prepare some of the other things that you have. And then, of course, we can always be reached. You can get by, email us, call us. We're always here for you, and we'll be navigating you through 2023. Thank you for listening to Lowdown. Have a great day.